First, though, the U.S. economy is showing signs of slowing down. The first quarter GDP numbers show growth more than halved compared to the end of last year. Owen Fairclough reports that this is what the central bank wanted to fight inflation, but there are concerns they may have gone too far.
After months of defying both rising interest rates and high inflation, the US economy is finally showing tangible signs of slowing down. And that's what the central bank wanted, to cool the economy and drive down those price rises. But how much of a slowdown is too much?
Gross domestic product in the first quarter of this year increased by just over 1%. Compare that with 2.6% in the final quarter of last year. And yet, despite persistently high inflation, consumer spending remains robust, but business inventory investment was sharply down.
And that metric is significant to some economists because it suggests employers aren't as confident about the future as they were just a few months ago. Amid concerns, a recession is on its way.
And just after those GDP numbers were released, retailer Gap announced 1,800 layoffs, just months after cutting 500 posts, and amid tech companies cutting tens of thousands of jobs.
This is the kind of financial pain that the central bank, the Federal Reserve, said it deliberately wanted to inflict upon the economy to cool it down. It's been raising its benchmark interest rate to make life more expensive for businesses and consumers and to try to slow down their activity. But the Fed said it's aiming for a soft landing, not a recession.
US President Joe Biden says the latest numbers suggest the economy is merely transitioning to sustainable growth.
Even so, some economists now expect growth for the next quarter to be a measly 0.3%. Owen Fairclough, CGTN, Washington.
First-time applicants for unemployment benefits in the U.S. fell last week despite layoffs at Disney, Amazon, and others. 230,000 Americans filed for claims for the first time, down slightly from the previous week. The labor market continues to show strength, even though rates keep rising and inflation is still above the Fed's 2% target. In total, 1.9 million Americans claimed unemployment insurance in mid-April. And with that, we turn to Wall Street, where John Terrett has the latest on the big earnings on the markets.
After the closing bell on Thursday, one of the big tech titans gave us their latest earnings. It was Amazon, of course, and it was all pretty good stuff. Very strong earnings report from Amazon, both in terms of the website and deliveries and in terms of AWS, their web services company. A big beat on the revenue, earnings per share coming in more or less where we thought it would. AWS growing by 18%, which is being seen on Wall Street as pretty good given everything that's going on. Remember, they are laying off 27,000 people around the world, though, the better to prepare for some kind of recession. But anyway, Amazon shares after hours ahead by 11%. Intel, the chip maker, up 3% after hours after beating with their earnings. But Snap Inc., I'm afraid, several misses. Shares punished, down 20% in the after hours here in New York. On the main markets, well, the GDP figure that came out much earlier in the day really drove things, I think. The takeaway, the consumer is strong, hiring is strong, but business spending took a hit. And the markets took that as a hint that the Federal Reserve may not go on raising interest rates too much longer, if at all. We'll see next week. Anyway, on Thursday, the Dow was up 1.5%, the NASDAQ 2.4%, the S&P 500 by 1.9%. Bitcoin had a good day. It was up 4%. On Friday, earnings continue. The oil majors, Chevron and Exxon. John Terrett, CGTN, on the trading floor of the New York Stock Exchange.
For more about the U.S. economy, I'm joined by Danill Manaenkov. He's the head of U.S. forecasting at RSQE at the University of Michigan. Good to see you again, Dan. If I had told you a year ago that the Fed was going to raise rates to where they are today, it's almost at 5%, and I told you that GDP would still be at 1%, I think we wouldn't believe it. What's going on here?
I agree with you. Thanks for having me back. So today's numbers are actually surprisingly good to me. So I mean, the headline is 1.1, but we typically never look at the headline number. So there are a couple of components that are very, very volatile. That is the contribution of net exports and inventories. And once you subtract those, this quarter growth was actually the strongest in a few quarters. So I think it's actually good news. And inventories declined largely because consumer was so strong. So to me, this basically signals that the Fed may keep going. And the markets, at least the bond markets right now, that expect the Fed to start cutting rates sometime later this year, may be in for a surprise.
Right. So the original consensus was that the Fed was going to either stop or slow the interest rate hikes. The economy would slow down to the point that the Fed would worry about the economy and potentially cut rates, say in Q3 or 4. But looking at today's numbers, if I'm the Fed, everything's on fire, right? Unemployment's record low. You've got plenty of money still floating around there. Yes, you have a little bit of a banking crisis, but the consumer seems to not be impacted. A few companies are tightening their belts. And that would make me think, if I'm the Fed, that my fight against inflation really isn't working to slow the economy down. Or do they say, let it sit for 6 months and see what it looks like?
Well, the latter will probably be their preferred option in the near term, depending on what happens to inflation. So the numbers that we got today from the personal consumption expenditure deflator were pretty much confirming what we knew from the CPI report, that some of the service price inflation is not slowing down. So to me, this tilts the balance of the risk somewhat toward more tightening, which may be needed later on. So I think at the moment, the expectation is that the Fed will probably stand pat for a little bit, but that's all conditional on what happens to inflation. And the expectation a year ago was that if the Fed had to raise rates as high as they did, that would certainly have slowed the economy much more than what we've seen so far. So the economy seems to be very robust, at least in the near term.
Right.
There are a few,
and Dan, I feel like for those who don't watch the markets on a day-to-day basis, like probably you and I do, I think there's this expectation is that, you know, you take action, you raise rates, and the market just changes immediately next week. And that's not how this economy works, right? We are a massive economy. It's a massive ship. It might take a year. It might take 2 years before you see an impact to the economy. And I think that's what average people struggle with, because they hear this conversation and they think to themselves that, well, why isn't the market reacting? But this is somewhat normal in a sense that there's a huge lag from when you do something to when there's an impact to the economy.
Right. So the standard monetary, empirical macroeconomics tells us that whenever the Fed does something, it's going to have an impact maybe 6 to 12 months from now. So the Fed's job is basically steering the economy, looking out the rearview mirror. And that makes it very, very hard. But it's also, I bet there is some doubt in the market right now, given that we have seen this much tightening, but the economy is doing, I'm not going to say great, but it's very, very resilient. So the question is, maybe the interest rate sensitivity of the economy is not what it used to be.
Now, okay, the other thing is, by the way, these numbers reflect what happened last quarter, right, in essentially Q1. This was prior to the banking situation that we have right now. And some are saying that the banks are tightening credit. That's going to have an impact on not only business spending, but possibly consumer spending as well. We're not going to see those numbers till the following quarter. So is that something we should look into when we analyze what the Fed may or may not do next?
Right. So, I mean, that is accurate. So GDP is a considerably backward-looking indicator, but the more up-to-date data, so for example, we got unemployment claims today. They're up a little bit over, say, the fall, but 240,000 new claims is not a high number. So if you were to look back at the prior decade, it's pretty low. So the labor market, which would probably react the first, is not showing signs of stress. No, I want to say that we are still thinking that a recession, a mild one, is probably likely somewhere around the turn of the year, because there are many headwinds. So the the commercial real estate is probably going to be struggling. There may be additional credit impulse for the small and medium-sized banks, who will have to probably improve the quality of their books, and they'll do this by constraining lending. There's an expiration of the student loan repayment moratorium, which is basically going to take out some money out of consumption in the economy. So there are some headwinds, and there are things to be worried. But in the immediate future, I think the momentum is pretty strong.
Dan, we'd love to talk about this more. We'll save that for next time. Thank you.
Thanks for having me.